I have on the phone with me today Tim Souther, and he is with Capital Partners, a Certified Development Corp. And are you guys out of Atlanta?
Yeah, we're based in Atlanta, off of 285 near the Braves Stadium.
Tell me a bit about your background.
Yeah, so Harold, thanks for having me on the interview, of course. But yeah, I've been doing SBA 504 loans since 2000, so I'm in my 22nd, 23rd year. Um, Funded over 400 504 loans in my career, and a good percentage of those were are gas stations. But I started out in government guaranteed lending, doing USDA BNI loans, and then quickly drifted over to 504 loans about 22
Wow,
years ago.
I bet that was torture. So
Yeah, 504 is so much better than the USDA process. So.
excellent. Well, 400, that's a phenomenal amount of loans to have done for 504s because honestly, I might do a couple a year. Um, I like them. It's just they have a place, and when you specialize in petroleum, we try to get things done conventional first, but we still do a lot of government backed lending. Got
Yeah,
a couple
yeah.
questions
The
for you.
key, the key on just real quick on 504 is working with the correct, the right CDC. I mean, we're all different. I mean, there's large CDCs that do, 300, 400 loans a year, and then there's small CDCs that do one or two loans a year. And we kind of fall in the middle. Last year we did about 80 loans here in Georgia. So if you work with somebody that's got a good team and got good underwriters and a good process, it's not going to be frustrating. But when you work with CDCs that just don't do a lot of business, it's just they just aren't up to speed on what SBA requires on some of the applications, and it just causes frustration. So
Gotcha. Some questions for you. What's the most common questions or concerns you get regarding a 504 loan?
I mean, on any 504, and including gas stations, of course, the biggest issue usually for the borrower is just how much are the fees, what is the down payment requirement, and then, what's the timing? It is a government loan, so it's a little bit lengthier process than conventional, but, the fees are, it is government backed, so there are fees built into the SBA loan. They're about, right now, about 2.15% of the SBA loan amount, which my marketing spin on that is it usually works out to be about 1% of your project. Because we're only doing on a gas station 30 to 35% of the deal, so that 2% of that portion is about 1% of the project. So once a borrower kind of sees it in dollars instead of a percentage, it's palatable, so to speak. Down payment ranges from 15 to 20% because SBA considers C-stores, gas stations as special purpose. So unlike multi-purpose properties, you can't get down to the 10% level, but 15 to 20% is the down payment, depending on whether it's a startup or an existing business. And then as far as timing goes, I mean, like I said, work with a good CDC in your market. We cover Georgia. But a general time frame that we quote people, and it depends on SBA's weekly turn time updates and things like that, and how busy we are internally. But somewhere in the 60-day process from start to finish, that includes bank underwriting and our underwriting, and then getting it approved through the SBA.
Gotcha. Okay. What would you say are the most common misconceptions about a 504 loan?
So the biggest misconception I hear about is collateral requirements, because there are two SBA programs, 504, which is what we do, and then there's the main SBA business program is called the 7A loan program. And 7A has a all available collateral requirement to get them up to proper coverage on the loan. Whereas, in general, or just typically, we take just a second mortgage on what we're financing. So on a C store, that would generally be just the real estate and the equipment that's being financed. So only in a case of a collateral shortfall would we have to look to other collateral. So there's no automatic additional collateral requirements. There's no automatic life insurance if you have multiple partners that we can rely on. There's no life insurance requirement there. And then the other misconception is that it's a 10.98 prepayment penalty. So we're doing 25-year loans, and it is a 10-year prepayment penalty period, but it does not start out at 10%. It starts out at, there's a formula, it's formula driven based on the interest rate. So currently, the note rate within the bond is about 5%, and that's before the fees. So the investor that's funding the bond gets, there's a formula. So it starts out at 100% of that note rate in year one and scales down over the 10 years. So right now the prepayment penalty starts at 5%. So, just sometimes people hear that 10%, or I'm sorry, 10-year prepayment period,
Mm-hmm.
and they automatically default to, thinking it's 1098.
Right. And I just learned something there. So that's good. So this might sound like a bit of a nutty question, but can you use the 504 to buy commercial real estate? And when I say commercial real estate, I mean something that's not like retail, like a restaurant or gas station, car wash, hotel.
Well, if you're referring to like an investment property, the answer is no. I mean, it has to be an owner-occupied property. If it's an existing building being purchased, the owner of that building needs to operate a business within that building at least 51% of the square footage. On a new construction, that requirement initially is 60%. The good thing about C-stores is that SBA does allow us to count canopies under canopy square footage, because that's actual square footage being used by the business to generate income. So, C-stores, obviously, when you think about most of them, they typically have the C-store in the middle and then some, rental retail spots on the side. So a borrower is able to have some tenant space. It just, there has to be within that, generally no more than 49% of the total square footage.
Gotcha.
But yeah, as far as real estate goes, that is the main use of the program. I mean, this is SBA's fixed asset program, so real estate and or equipment are our main uses of funds.
What would you say is when is a 504 loan a better fit, or when is a 7A a better fit?
So both programs have their pros and their cons. 504 is more limited in scope. Like I said, it's only for fixed assets, so we don't finance business, goodwill. We don't finance inventory, working capital, things like that. But ideally, if you need some of those things, let's say you have a customer that wants to buy an existing gas station. Generally, that purchase price is going to be allocated to real estate, equipment, and there might be some allocated to business value. So you can do it a couple of different ways, but you could put just the real estate under the SBA 504 loan program and get that nice 25-year fixed rate on the SBA portion, and then finance the business assets, maybe the equipment and the goodwill under 7A, and put those on the shorter term. It's usually a 10-year 7A loan for business acquisition. The equipment can really go on either bucket. We can finance the equipment on the 504 side, or you can shift it over to the 7A side. Now, some banks might just steer the borrower into just one 7A loan, which is totally eligible. But one of the advantages of 504 is the long-term fixed rate. So if you get all of your financing through 7A, you're most likely getting a floating rate on that financing versus the fixed rate on the 504. So we encourage banks to send the fixed assets through 504 and then finance anything ineligible as a companion 7A loan, because you can use both programs on one project.
Okay. Do you guys normally list the bond debenture rates on your website?
Yes, we update those monthly. The debenture pricing is the Thursday of the first full week of each month. So we send out, we have, I think, a few thousand people on our monthly rate list, where we also detail, our fundings for the month. But as long as I remember, I'm also the website IT updater. So I also update the website.
Gotcha. And what's your website?
Our website is cpcdc.com. So that's Capital Partners CDC.com.
Gotcha.
CPCDC.
Okay. My next question is, How does the green program work, and what's the actual maximum loan amount? Because I mean, I know, or I thought the maximum you could do for a, well, I'll just let you take that over from there.
Sure. So the regular maximum between the two programs, as far as SBA guaranteed dollars, is $5 million, and that's to a borrower and any affiliates. Now, if you have a borrower that's already used up their SBA eligibility, the 504 program does offer what you just mentioned, quote unquote, the green program. Basically, it's energy efficient, what we call public policy goals. So if you have a project that meets one of those green public policy goals, we don't have to subtract any existing SBA debt from their eligibility. So that project can stand on its own and qualify for its full, on our program, 30 to 35% of the project without being, either deemed ineligible or having to reduce our loan amount because of other existing SBA debt. So the way a borrower qualifies for that, there's two ways. You can either be reducing your energy need by 10%. So not sure if this would really apply to a C-store gas station, but say you have a dentist that's in leased space and they're going to buy a building to move into, and they can show that this building is more efficient than the space they're in by at least 10%. So you can qualify that way, really potentially without any capital expenditures whatsoever. The more common use, or the more common way to qualify, is through renewable energy, which is where you're expanding. You're either buying a gas station, you're building a new one. And in that case, you would have to put something that generates renewable energy into the project. So in Georgia, the most common way we see is solar panels. So somebody would put solar panels on the roof of the C-store to power at least 15% of that building's annual need, and we would help the borrower through that process. There's some companies that do the analysis and get the quotes for the system, and then we finance that cost into the project, and then the borrower gets any tax benefits, tax credits, and obviously some utility savings throughout that as a result.
Sure. I see the number 16.5 million. I see 20 million thrown around. Are those just fake promoting rumors, or?
Yes. Sorry, I forgot to answer that part of your question. So it's $5.5 million per project, up to $16.5 million overall. So you can have, theoretically, I don't think we at least haven't tested these waters with any particular borrower, but per SBA's SOP, standard operating procedure, you can get your regular $5 million, which would be 504 7A combination, and then an additional $16.5 million of green 504 loans, each limited to $5.5 million maximum. So if you did three super large projects, three $20 million projects, each one of those could have a $5.5 million 504 loan attached to it. But the overall limit is $16.5 million. So if you had smaller projects where each SBA loan's only $1 million, then you could do just any number of projects, 16, 17 projects.
Gotcha. Okay. The next question I had is about construction. Is doing a 504, if you're doing construction loan for that, and you and I were just talking about one project in particular that you just finished up in Georgia, is it more problematic than doing a 7A? I mean, we know that it's a little more paperwork just because it's a government-backed loan. But is it more problematic for a 504 than it would be for a 7A loan on construction projects?
Well, I think from my perspective, obviously we prefer deals to go through 504, but I'm not a 7A lender, so hopefully I'm not answering this incorrectly. But I think the bank can get the SBA guarantee, which is 75% of the loan during construction on a 7A loan, versus on a 504 loan, the bank is funding the construction loan. So let's call it 80% of the project. They're funding that conventionally until until the borrower finishes construction. They have the CO, the loans are fully funded. And then at that point, we close on our portion of the loan, which pays down the construction loan from 80 to say 50% of the budget. So from a banker perspective, it might be a little less risky because you're guaranteed throughout the construction phase at 75% of your loan amount with SBA if something were to go awry. But on 504, you're doing it. You're just doing a conventional loan.
Right, right.
One way banks can mitigate that is you can simply take some additional collateral just during construction. You can take life insurance just during construction. So there's ways to kind of shore up the position of the bank during construction. But construction is the riskiest time for the bank in a 504 process because you want to make sure they can get to that finish line so the SBA can come in and pay down the loan. So.
Okay. We know that when you're doing a 504, it's not 50-50, meaning 50% from the first and 50% from the CDC. How does those percentages break down?
Yeah, so your first step is to just figure out what's your total project. So let's go with a simple scenario where it's just, let's say you're purchasing an existing gas station for $5 million. There's no renovations. It's just straight $5 million. So in that case, if you're dealing with an experienced buyer in the industry, the down payment requirement's 15%. So you're going to take that $5 million purchase price. You're going to add the closing costs. You got title work. Here in Georgia, we have intangible taxes, obviously the appraisal, environmental, things like that. Whatever that total budget is, they're going to put in 15%. The bank's going to fund 50%, and we're going to do 35%. So the total budget gets split 50, 35, 15. If that was a ground-up construction project, you would add up the land, the cost of the construction, architects, engineers, utility, tap fees, just everything you can think of that's in the project, and add in the equipment, closing costs. We can fund construction interest and build in the contingency, and then whatever that total is, it's generally 20% down because that's a new business. So 50, 30, 20. So as you can see, the bank is usually always at least 50% on a special purpose project like that, and then we are between 30 and 35, and the bank is between 15 and 20. The borrower's between 15 and 20.
Is that split the same on other types of properties?
If it's a multi-use property, let's say you're financing believe it or not, restaurants are multi-use, self-storage is multi-use, and then obviously, just general office and warehouse, things like that. You can be as low as 10% down, and in those cases, the bank's still at 50, we go up to 40, and then the borrower's just putting in 10.
Okay.
So gas stations, hotels, car washes, kind of what you would think of as a special or single use type building, those start out at 15 instead of 10 on the down payment.
Gotcha. I've got one last question because you touched on it as we've been chatting. Since the 504 does not cover inventory, and on a gas station, convenience store, truck stop, between the fuel in the ground and the inventory inside the convenience store, that can be 75, 100, 150. It can be a lot of money. How do you guys try to do a 7A behind it, or what?
Yeah. So that's where you're just having that conversation up front when you're structuring the deal, either with the banker bringing you the deal, or if you're working with the borrower directly. But that would either be funded with additional cash from the borrower or as a companion 7A loan. So that's where if you're doing a new C-store gas station and you have the need for startup expenses, working capital, inventory, sometimes might be some franchise fees if you've got a Subway inside or something like that. All of that can be funded through a companion 7A loan or with additional cash from the borrower.
Are you able to count like fuel supplier equity as part of the equity? As you know, a lot of these fuel suppliers, as an inducement to go with a particular brand, might give them, a chunk of money up front. Can that be used as part of their equity, and what percent has to come from the borrower as opposed to maybe from a supplier?
No, any supplier credits, just like if there was a credit on a purchase price, gets subtracted from the budget. So it's not even in the budget. So that's just kind of outside of our project. So it doesn't count towards equity or anything like that. It's just outside of the project.
Gotcha.
As far as, excuse me, as far as, the source of the borrower's down payment, obviously we prefer cash, but if they're borrowing from like a home equity line, or, we've even got banks that'll maybe lend them some of the equity as, a third mortgage or, something on the building. So you are able to, get gifts from relatives, borrow the equity, as a CDC, and this is just our kind of internal policy, we like to see at least half of the injection coming as cash. Just the old saying, just liking the borrower to have some skin in the game, so there's some risk to them as well. So but yeah, you can, like if you're purchasing an existing gas station, the seller could technically hold back a note for the down payment.
That was one of my questions I was going to actually ask on that, is if that's allowable. So that's good to know. I've gone through my list of questions that I had. I just noticed as soon as I said it, I called the CDC a Certified Development Corp, and it's not. It's a company. But anyway, but I appreciate you being on the call, Tim. It's been very informative. And again, we've got your CDC address. Now, I know that you're probably doing deals in contiguous states too, because I know it used to be years ago you had to only deal in that particular state and CDCs that were there, and then they changed it to where you could go to a CDC in a contiguous state. So I'm assuming that you guys on occasion do deals outside of Georgia.
Occasionally, the main thing there would be is that we are able to go into another state. It doesn't necessarily have to be contiguous if we have that borrower as an existing customer already. So if we get one loan funded with somebody here in Georgia, we can then follow them to another state. We like to focus just on Georgia. That's our market. That's where we know. We have relationships with other CDCs, say Florida or Alabama, South Carolina, any state. There's 5 states that touch Georgia. And then, I have friends throughout the country, in other states. So if anybody needs to reach out to me, and I can always just do some research and see what the highest volume CDC is in that state on our trade association's website. So we only cover Georgia, but there are some cases where we would go into other states. For example, we're here in Atlanta. It's easier for us to service a loan in, say, Chattanooga, Tennessee, than it is in Savannah.
Oh, of course. Yeah.
An hour north of Atlanta versus 4 hours down to the coast.
Sure.
So there are exceptions where we can go into other states.
Okay, excellent. All right, Tim, I appreciate it so much for you spending this time and answering these questions. And on the video, you'll see their website, and I'll have his contact also in the video. And should you like to give him a call about one of your projects, feel free. But thank you so much, Tim. I appreciate it.
Yeah, thanks, Harold. Thanks for having me.
All right, you bet.